Good morning, good afternoon. Welcome to this webinar on Wednesday. What is it, October 7th? No, October 6th. It's 11 a.m. Pacific time. We're here. I'm Eric, and this is Alana over there. And we're doing, this webinar is all about, it's part of a longer series on contributions. Last week, we did employee salary deferral contributions. This week, we're doing employer profit sharing contributions. Before we get started though, if you guys are in the webinar, go ahead and just give us a thumbs up or just let us know, can you see us? Can you hear us okay? Just a quick tech check. I see lots of people piling in. Maybe let us know where you're watching the webinar from. We'll give it a second because typically there is a little delay. And also, if you guys have questions immediately that are on the top of your mind, go ahead and use the Q&A section of the webinar. It says ask a question. Go ahead and post your questions right down there. You can use the chat for, just commenting, that kind of thing. I do see lots of thumbs up, so it sounds like everybody can see us, can hear us. Awesome. Still got a few people joining. But yeah, go ahead and post your questions down below, guys. We'll go ahead and get started with the webinar. Perfect. Lots of different folks coming from different places. Looks like James is in San Diego. I'm jealous of that. Lots of great weather there. Perfect. Can you see that okay, Alana?
Yep, looks good.
Awesome, awesome. So we're going to be doing this webinar all about solo 401k contributions. This is part of a larger series like I talked about. We're going to be doing more on after-tax contributions, employer. This is going to be all about employer profit sharing contributions. So we'll dive deeply into that today. Quick little disclaimer. Obviously, this is not legal advice. This is not tax advice. We're not your investment advisor. This is just education, right? We want you to really get the most out of your solo 401k plan with Nabers Group. And so we do these topical webinars on Wednesdays. If you guys want more informative webinars, just go into our network. All the webinars are posted in there, all the past ones. You can search by topic, find all kinds of great things. We love doing these educational webinars. I think that's what keeps all of our clients coming back, obviously. So a little bit about us, we launched the IRA LLC in 2003 and the solo 401k back in 2006. So we've been doing this for a while, the checkbook control plans, right? Consistent IRS document approval for the past 15 years. And what's really cool about our team is that everybody here does have those checkbook control accounts. So we all have done the things that you guys are doing, right? So any question you have, we've probably encountered it personally. So also our team does work closely with the IRS and the Department of Labor. So we are on their approved list of providers. That way, obviously, we're making sure that all your plan documents are in compliance, up to date with the latest IRS amendments and changes that they're pushing out. So on contributions, right? There's a couple ways to get money into the solo, right? You can roll money in, but the other main way is through contributions. So if your business is earning profits, right? If you're making a profit in your self-employment income or your business, you can contribute a portion of that into the solo 401k. Now, contributions can be pre-tax, and they can also be after-tax or Roth, right? Since you're both the business owner and the employer, and you're the employee as well, you do have multiple ways to contribute to your solo 401k. Now, without getting a little bit, too complicated, there are two types of contributions. You do have employee salary deferrals. We went over this in really great detail on the last week's webinar. So if you guys missed that, go back and watch that one. It was relatively quick. You could watch it probably in 20 to 30 minutes, the highlights. But yeah, those can be up to 100% of your compensation. maxing out at 19,500 for those that are under 50. And it can be either pre-tax or Roth, or it could be a combination of both. Also, you have the employer profit sharing contributions, which can be between 20 to 25% of your net profits. And that really does depend on your business structure. And that one is always pre-tax. Maximum contributions for the solo 401k are 58,000, so super high contribution limits. That's for 2021. If you're 50 or older, the maximum is 64,500. Now, contributions are based on net compensation. So, right, the more that you earn, the more that you can contribute. So we're going to do deeply into employer contributions today. Really, it does depend on your business structure, right? So it is between that 20 to 25% of your net self-employment income or W-2 wage. And like I said, it is always pre-tax. So just a quick visual so you guys can see exactly what I mean by that. You have those two buckets. You have the traditional / pre-tax. You have the Roth. Down below, you can see the employee salary deferral can go into either or both, combination of the two, or just one or the other. The employer profit sharing is always going to go into that pre-tax bucket. Okay. Now, profit sharing contributions are in addition to your employee salary deferral contributions. So the total amount does depend on your business structure. So for sole proprietors, single member LLCs, this is 20% of your net self-employment income. There is a deduction that you do. Make sure to work with your tax professional on that. There's you do half of your self-employment income as a deduction before you do that 20%. So you can take a look at our calculator as well. It goes over that as well, but definitely work with your tax professional. For S corporations and C corporations, it's just 25% of your W-2 wages. And then for multi-member LLCs or partnerships, it's 25% of that K1 line 14, which is your self-employment income. Definitely for partnerships, you definitely want to work with your CPA as well. There's some additional complexities there as well. But it's basically 25% of your line K1 of line 14.
Great. Thank you, Eric. So let's go over Isabel's example. So Isabel is 27 years old. She has an LLC taxed as an S Corp. She is the sole member and the sole owner of her dog grooming business. She pays herself $50,000 in W-2 wages. How much can Isabel contribute to her solo 401k as profit sharing? So she can contribute $12,500. How did we get to those numbers? $50,000 times 25%. So she can make $12,500 in her employer contributions. Also, on top of it, for her employee salary deferral, she can do the $19,500. So she could possibly have a total tax deductible contribution of up to $32,000. We like a good visual. So as you can see, the employer profit sharing, that's always going to be traditional or pre-tax. So she's going to put that $12,500 into the traditional bucket there. As for her employee salary deferral, she can do that either as traditional or as Roth. You know, this is all a personal decision. If you make it as traditional, you get that taxable deduction. For Roth, you get the benefit of everything growing tax-free upon distributions. Now for John's example. So John is a 45-year-old doctor and is the only employee of his S Corp. He pays himself $240,000 in W-2 wages, which means he can max out. He can do that $58,000 into his solo 401k. As you can see the breakdown, employee contribution is $19,500 and the employer is the $38,500. So since John's profit sharing contribution calculates as more than the maximum, he can only do the $38,500. So even if, you know, the 25%, it puts you above that $58,000, you can't contribute more. Just always remember, you cannot contribute more than the max. So it's $58,000 if you're under 50, and it's $64,500 if you're over 50. As you can see, for the employer, he can put in that $38,500, which is the max, and that's going to go into traditional. For the employee, of course, John can choose, is that $19,500 going to go into Roth, or is it going to go into the traditional bucket?
Yep, we got another example with Lucy. Lucy's a 35-year-old freelance artist. She is the only employee of her S corporation, but she also has the W-2 job at a large graphic art firm. She does max out her contribution at this company, so she's putting in that full $19,500 into her job's 401k plan. She pays herself $60,000 in W-2 wages out of her S corp, which means that her total profit sharing contributions to the solo 401k can be that $15,000, which is 25% of her W-2. She cannot do any more salary deferral. Just to show you guys that visually, she's got the two plans, right? She's got the job 401k on the right, and she's got the solo 401k on the left. So with the employer profit sharing contribution, that's that $15,000 goes into the solo 401k. On the pre-tax side, she cannot do any salary deferral because she's already maxed that out over on the right-hand side in her job. Also, another example, this is with two participants, right? With the solo 401k, you can participate yourself plus your spouse, right? So if you do have a spouse, it's an owner-only plan, but if your spouse is receiving compensation from that sponsoring business, then they can participate as well, and they can make contributions. So we got CHRISTI, age 50, and Lance, he's age 52. They're both real estate agents. They each pay themselves $154,000 of W-2 from their S corp. CHRISTI can contribute that $64,500, which is the $26,000, including that, it's $19,500 plus a $6,500 catch up. So the full $26,000 of salary deferral. And she does another $38,500 of profit sharing, bringing her up to that max. Also, Lance is doing the same. So they can make a total contribution of $129,000 between the two of them. And that reduces their taxable income by that full $129,000. So what does that look like? You basically have two different participants. This is all within that same solo 401k plan. You just have two participants, right? And then you have each of them has a traditional, and each of them has a Roth bucket, right? So for CHRISTI, she's putting that $26,000 into the traditional, and that $38,500 of profit sharing also into the traditional. Same with Lance, they're both going into that traditional bucket. Keep in mind that salary deferral could also go into the Roth if they wanted it to, right? That would not reduce their taxable income, but it would forever be in that Roth bucket.
Okay, contribution deadlines. So your contributions are always due at your business when your taxes are due for your business. So of course, if you file an extension, it goes along with the extension as well. But it is important that the IRS does want you to formally elect your contributions by December 31st, which I know can sound silly because maybe you don't know exactly what you're going to put in. You're not quite sure, but it's just as simple as using our contribution form and just, writing down what you plan on contributing. Keep it somewhere safe, show it to your CPA. It can change. That's okay. So you want to formally elect, which just means keeping note of it, but your contributions are going to be due on your business tax deadline. As you can see, this is IRS publication 560, and this is a qualified retirement plan. And you can see it does state here when your contributions are due.
Perfect.
It's too late to contribute as an employer. So it may not be. If you got an extension, if you're a C Corp or a sole proprietorship, you may still have time. The deadline is right around the corner, October 15th, but only if you have an extension and if you're a C Corp or a sole proprietor. This is a great webinar. If you guys have not seen this, it's with John Heyer, and he goes over contributions for 401ks and IRAs. It is a great, great webinar, and it always is fun to watch John Heyer and, of course, Rachel.
Awesome. Perfect. So we're going to do some frequently asked questions. We did some of these last time, but we do get lots of questions about contributions. So we're going to do some more today. One of those is, can I contribute to a SEP IRA and a solo 401k at the same time? So basically a SEP and a solo, if they're connected to the same business, contributions are limited to that 58,000 or 64,500 if you're 50 or older. Calculate your contributions based on that business, right? Whatever it earned. So the big difference is that solo 401k, you have the ability to do employer contributions and those employee salary deferral contributions. With the SEP IRA, it's just the employer contributions. Just be sure, if you have a SEP IRA and a solo, that you just don't want to make sure that you don't over contribute, right? Because those profit sharing contributions count for across both of those. If it's the same business, right? If it's two different businesses, check with your CPA if those are, if they're not a controlled group. If it's not a controlled group, then you may be okay to contribute to both. But yeah, you want to double check with your CPA. But let's take a look at, how the solo 401k differs from the SEP. Basically, with the solo, like we already talked about, you have two ways to contribute. You have the employer profit sharing, and you also have that salary deferral. So if your employer profit sharing, that 25% or 20% doesn't get you to the max, then the solo 401k is going to be a way better plan for you. It's going to be able to get you way more contributions, right? The SEP IRA just has that employer profit sharing. So no employee salary deferrals are allowed into the SEP. So just keep in mind, that employee contributions limits are per person. So basically, that's that example we did with Lucy, where if you max out your employee salary deferral in like your work plan and you have your solo, you can't do more salary deferral than that full, 19,500. But employer contribution limits are per plan, right? So if you do have two different businesses, like I talked about just a second ago, you may be able to maximize that employer contribution to both plans. It just depends. If it's not a controlled group, that means that those businesses don't like share resources. There's really like kind of specific definitions, a little too much for us to go into on this webinar, but definitely something to check with your CPA. As long as you're not a controlled group, you may be able to contribute to both for both businesses for that profit sharing contribution. Another question we get quite often is, can Social Security income be contributed into my solo 401k? So the answer is no, right? The only income that can be contributed is from that adopting business, right? So Social Security income, it's a pension, right? It's based on your earnings from, your previous employment or your previous business earnings. So it's that pension. So unfortunately, it's not earned income. And it's definitely not self-employment income, so it can't be contributed into the solo 401k.
Can I contribute my highly appreciated real estate, precious metals, or cryptocurrency into my solo 401k without selling it? So, contributions. Contributions can only be made in USD. All your contributions must come from business income earned in the sponsoring business. Because remember, guys, there are two ways to fund your solo 401k. One is with new contributions, which is always going to be made in USD. The other is with rollovers. So you can roll over real estate if it's in a self-directed IRA. Same with cryptocurrency. So if it is in retirement funds and it's a traditional, not a Roth IRA self-directed account, it can roll into this. But if you just made like a lot of money on a property you purchased with your personal funds, or you made a lot of money in Bitcoin this year in your Coinbase app that's in your personal name, unfortunately, none of that can move over in kinds. So just keep in mind, contributions are always based on your business earnings and must be made in USD. Okay, like always, our services and support. So you guys have unlimited free access to our trainings like this, our support team. Also, like we've talked about a lot, our network. It's a great place to find our previous events, talk with like-minded investors, post questions. So if you have not been to solo401k.net, you are missing out. Check it out. And then, of course, our website, solo401k.com. It's like Google for the solo 401k. It's the Soogle. So definitely check that out. Our contribution calculator is there. Also on our website, you could find a link to our network and to our knowledge base. Our knowledge base, support.solo401k.com. Lots of great guides. Maybe you need to open up a brokerage account. We have guides on most of the big brokerage accounts. Maybe you want to open up your Coinbase account. We have a guide for that. So if you ever have a question and it's not during business hours, or you want to try to find the answer on your own, check out that knowledge base. I guarantee you'll find an answer there. Of course, if you would like to get in touch with us, maybe you're not a client yet and you would like to, discuss your particular situation, go ahead and book a call. Solo401k.com/consult. You'll get to talk to either Eric or I. Also, for all of our clients that are on here, the best way to get support is actually to email us. So you can email us at support@solo401k.com. We typically answer emails very fast. And of course, if you want to talk to one of our support team members, go ahead and give us a call.
Awesome.
Okay, so let's jump into some questions. And Eric, just so you know, I pulled all the questions that popped in and on the side and I put them in here. So no need to teeter back and forth. So
perfect.
So for the first question from Keith, how should profit sharing contributions get reported? Should they be reported as employer contributions when running payroll or just on the K-1?
Yeah, great question, Keith. You'll definitely want to talk to your CPA about those contributions, especially if you have. Looks like if you have a K-1, you must have either a single member LLC or a multi-member LLC. Just remember that it's line 14 that determines how much contributions you can make. As far as where that actually gets reported, I would definitely double check with your CPA on that or your tax preparer. Just remember we're not doing tax advice today. I wish that maybe someday we'll bring on a CPA that then could give you guys some of that information, but definitely check with them what box to put that into.
Great. And we do have some resources. I'm not sure if it's going to pertain to the K-1, but I'm just, on our website typing in some things. So remember, you guys can always check out our resources. Oh, I have something about partnerships. I will pull that for you, Keith.
And the question about it being part of payroll, typically not. The employer profit sharing contribution is made directly from the employer. So usually it's not a deduction during payroll, but typically it's coming directly off the top from the employer. So hope that helps answer that question. So we got another question from Vikram. While calculating employer share, we exclude the 1/2 of self-employment tax. Do we have to do the same for calculating mega backdoor Roth contributions amount? When we say net compensation, does that include self-employment tax as well? This question is for LLC not taxed as S Corp.
So I'm not 100% sure because this is a tax question, of course, but if you're doing, and I think you're trying to also talk about the voluntary after-tax contribution, and that's going to be based on the same line that you're looking at for all your contributions. So remember, for that voluntary after-tax contribution, it's 100% of your net earned income. So that's after deductions. That's after that, 1/2 of self-employment tax. So I would assume so. But of course, this is a CPA question, so you definitely want to defer to your tax professional.
Yeah, the big key is that you just have to have actually made that money after taxes in your business. So the half of self-employment tax really only applies to the deductibility of those contributions. So when you're doing the mega backdoor, I wouldn't think you would need to use that half, because you're actually doing the contributions after you've already paid all of the self-employment taxes. Hopefully that makes sense, Vikram. But that calculation, it's really only done to determine deductibility. So if you're not worried about deductibility, then you should be fine without that.
Okay, from Anthony. Can your company contribute to your 401k regardless of whether you contribute as an employee or not?
So, can your company? Yes, the answer is yes. So I'm assuming you're thinking solo 401k. So I'll just answer it based on that, Anthony. But with your solo, it's kind of like I told somebody else the other day, it's kind of like a choose your own adventure. You get to pick what features of the solo 401k you use and that you don't use, right? So if you don't want to use that employee profit sharing, don't use it. You can just, if you don't want to use the employee salary deferral, don't use it. If you want to just use the profit sharing, great. You can definitely do that. If you want to use both, you can use both, right? As long as you're working within the rules, you can utilize parts and pieces of it and not utilize others. Some people just want to do the mega backdoor Roth, which we're not talking about today. We're going to talk about that on another webinar. Some people just want to maximize their, deductibility of their contributions, right? So yeah, you definitely don't have to do any of those. You could choose to not contribute also, right? So it's kind of up to you how you want to structure your contributions. A good question here from Sergey. In a single member LLC, what are the limits for contribution from both employer and employee, being that both are the same person? Is it 25% plus from employee up to 58,000 in total?
Yeah, so great question for a single member LLC. For your employee contribution, if you're under 50, it's at 19,500. And for the employer, it's going to be 20% of your net earned income. So you just add those two together, but you can never exceed that 58,000. So great question. The next question from Deanna. For above 50 to max out on a 401k, how much do you have to pay yourself? $154,000?
Yeah, you hit it. You hit it, Deanna. So basically, because the employee salary deferral is that 26,000. So this is just a little bit of quick math for you guys. So the 64,500 maximum contribution limit, you have your 26,000 because you're 50 or older. You can do that full 19,500 plus the additional catch up of 6,500. So that's 26,000. So what do you have left, right? You have that 38,500. So it does depend on what your business structure is, Deanna. So if you are like an S corporation or maybe an LLC that's taxed as an S corporation, it's that 25%, right? So you would want to pay yourself whatever, take that 38K divided by 0.25 or the 25%. And yeah, that turns out, you're right. It's 154,000 of W-2 wages. It is a little bit more of a complicated calculation when you're a sole proprietor. So I would definitely double check with your CPA about that. I'm not going to go into the math on that. I'd have to get out my calculator or my abacus or something like that. But yeah, hopefully that helps. Definitely work with your CPA on contributions. It's not that complicated, but you do want to have an extra set of eyes anytime you're making tax decisions, right? Another question from James. He says, can I pay tax on profit sharing and put it in Roth?
great question, James. Your employer profit sharing contributions are always going to be traditional. So no, you cannot do that. But there is another strategy. It's that mega backdoor Roth. We're not going to get too much in the weeds about it. I know a lot of you are now very curious because we brought it up a bit. It is a way to get more funds into the Roth bucket. We will be going over that on I think that's going to be next week's or the week after. So we will be addressing the mega backdoor Roth here in the next few weeks. So great question. And then Mahesh wants access to this John Hire slides, and I put it in the chat box. So anyone else that's interested, go ahead and check it out and just click it and it'll take you right there.
Yeah, and Mahesh, if you didn't join the Solo 401k network, you should definitely join that because you'll find all those past events in there, as well as all of our upcoming events too. So you'll see, again, that mega backdoor event will populate in there, so you can go ahead and save your spot there. But yeah, that's definitely the place to be for all of the past trainings and upcoming trainings. It's a long one.
It's a long one, and it also might be really a CPA question. So if you want to address it, like maybe pieces of it.
Sure.
We need to do the calculations because this is someone's particular situation.
Right. So Steven says single member S Corp monthly salary 4,500, 2,166 per month is deferred to the solo 401k to get 26,000. Is there remaining? So there's remaining 2,334 gross wages paid to me each month. Okay, yeah. So it's it's basically asking what's the 25% employer contribution based on? Is it based on after those salary deferrals or before? So it's based on before. So it's based on your gross W-2. So that 4,500 salary, if that's for 12 months, take that by 12 months, and that's how you calculate the profit sharing contributions. 25% of the gross W-2 wages. And then it says, let's see, my adoption agreement prepared by Nabers under compensation has this box checked. Code section 415C3, compensation, can employer contribute? Yeah. So yes. So basically it's 25% of your gross compensation. Anything to add to that, Alana? Is that?
You always want to double check with your CPA, but Eric.
Yeah. double check with your CPA for sure.
Yeah. Contributions can be a little tricky. Okay, and for James, so can you tell me the 2021 S Corp deadline again? So for S Corp, your deadline is March 15th, and we have this great calendar that actually tells you all about your different deadlines. I refer to it all the time. So that'll let you know anyone out there that has all those important deadlines for you and your business. So check that out.
And then James had a follow on, said, what is the mega backdoor Roth? So we're gonna have to defer to next week, or either next week or the week after. We're gonna go into that in depth. There is a helpful article on our knowledge base, so it does go into that strategy. So
I'm going to pull it right now, so you guys can do a little research now.
Yep.
So you can be all prepared for the next webinar. But it is a great strategy. It is complex, so you definitely want to work with your CPA or tax professional because there is definitely some documentation, some moving of funds, but it is a way to get $58,000 into the Roth bucket.
Perfect. It looks like there's no more questions at this point. we'll give it just maybe a few more minutes here to see if any other questions come up. Contributions can be pretty tricky, guys. So yeah, definitely you want to check in with your CPA about these things. We're not your final say for tax advice. For probably not even your first say. Okay, we got another question that came in here from Mahesh. He said, do you have any CPA suggestions? So that's a good question, Mahesh. Yeah, not every CPA is solo 401k literate. So if you do want a list of solo 401k literate CPAs, we do have that on our knowledge base. So if you search CPA in the knowledge base, and looks like Alana just posted that, we have a bunch of CPAs that are literate in the solo 401k. Feel free to, use them for that purpose, or if you want to use them for all your tax stuff, great. But yeah, they're great. They know all about it. They can help you calculate your contributions, know about your specific situation. Maybe they want to tell you, maybe you should be an S corporation. Maybe you shouldn't. Maybe you should be a sole proprietor. They're going to walk you through all of those particulars of your business situation. So we got another question from Rami. He says, please define net income when it comes to 25% profit sharing.
So like we've discussed, it all depends on your structure of your business. So we'll go over them again. So sole proprietorship, you're filing, a Schedule C. So your net income is after deductions. So you'll see the net income on your Schedule C, and you'll take 20% of that number, and that'll be your profit sharing. That's the same for single member LLCs. You're going to find that on your Schedule C. For S Corps, C Corps, it's your W-2 wage you're always going to look at. That W-2 wage, you can take 25% of that, and that can go towards profit sharing. And then for partnerships, multi-member LLCs, you're always looking at your K-1, and that's line 14, because that's your self-employment line. So good question, Rami.
Yeah, and Rami, I would say refer to our calculator too. I think Alana posted in the chat there, but solo401k.com/calculator. That's going to give you a great starting place. You'll see how we calculate things there. You can choose whether you're incorporated or you're a Schedule C or sole proprietor, and then go ahead and put in your net income or your W-2 wages, whichever is relevant to your business structure. Another question from Rami says, is the income on profit sharing taxable or deferred?
Well, so all of your contributions, everything is tax deferred, especially, if it is your profit sharing, that's going to be traditional contribution. So that's all tax deferred.
Yep. Yeah, we went over that earlier. Maybe you just jumped on, but yeah, always profit sharing contributions are pre-tax. They're never Roth. So your salary deferral can be either pre-tax or Roth, or a combination of both. But that profit sharing is always pre-tax. So a question from Mahesh. He said, if you have time now or maybe for another webinar, is it possible to walk through the calculator and how to use it? Yeah, we want to do that. Should we?
Yeah, absolutely.
I can pull it up here.
And remember, this calculator is a great starting point. It's not going to be exactly what you want to contribute because you want to double check with your CPA, but it really is a great place to start. And you'll see how cool this calculator is. It's going to compare it to other plans as well. So
share my screen. So solo401k.com/calculator. You'll see here, you want to obviously select, what your business type is. It's relatively simplified here, right? So if you're unincorporated, so that means if you're like a single member LLC, that's like just a pass-through entity. You're taxed as a sole proprietor, you should choose that unincorporated. If you're incorporated, meaning you're either a C corporation, or you're taxed as a C corporation, or you're an S corporation, or you're taxed as an S corporation. Again, you want to check with your CPA about these things. You want to pick whichever one makes the most sense or is relevant to you, right? Two essentially different ways to do that. Single owner corporation, let's just choose that. Say you're an S corporation. Your W-2 wages is what you would put in here. So you have a little, question box that just pulls that up for you. If you are that S corporation, it's going to be based on your W-2 wage. Let's just say that it is 100,000 for simplicity. And your age, let's say you're 56. It's going to go ahead and calculate for you. So you can see right across the board, solo 401k contributions can be up to, this is deductible contributions, up to 51,000. SEP IRAs down to, it's only 25, and the simple IRA is only 19.5, and that profit sharing is only 25,000. If you go ahead and click view report, it's going to pull up a little bit more details on that. And it's going to show you the same graph, and then down below, it's just going to show you how those contributions actually break out. So you've got the results summary. Over here on the left-hand side is that individual 401k plan for 2021. That you can see over here that question we had earlier about are the employer profit sharing contributions based on the gross income or the net after deferrals? You can see on our calculator it does show that 25% of that W-2 income. Again, double check with your CPA. We're not saying that this calculator is tax advice for you. This is just education. But then you also do have that elective deferral amount. Plus, since this individual is 50 or older, they also have the catch-up. Keep in mind the maximum allowed contribution is $64,500, but the maximum for this person, the maximum deductible contribution is that $51,000. Hopefully that makes sense. You guys can play around with that, put in your own numbers. You can go ahead and hide that report, and it brings you back to that same screen. Yeah, that's pretty much it. Anything else? Should I do anything else, Alana, or what do you think?
Oh, yeah, looks great.
All right, awesome. Thank you.
Okay. Should we wrap it up for today?
Any last straggler questions?
Eric, do you want to talk about your webinar tomorrow?
Yeah. If you guys are not investing in Bitcoin or cryptocurrency, and you want to learn more about why you should, we're doing a webinar tomorrow talking about all about Bitcoin, all about cryptocurrency, and all about how to actually get it into your retirement plan. So it's kind of interesting. You have a lot of people that are investing in these cryptocurrencies, but they're doing it in a taxable way. They're doing it with personal funds, right? And then you have all these folks that are have all this retirement money, but for some reason, there's not a lot of meeting in the middle. So we're going to go over, why Bitcoin's important, why to invest in it, why to invest in it now, and also crypto as well. And then we're also going to talk about, our solution for getting it into your retirement plan.
Awesome. Yeah, I'm looking forward to that.
Yeah, it's going to be really good. Yeah, it's going to be me and Rachel Nabers. She's the VP, so she's going to bring all of her knowledge and expertise as well. It's going to be awesome.
Okay, and then join us next week. So next week, I do think we are going to do voluntary after tax is what we're going to focus on. So come learn about that. We look forward to it. And like always, if you need support, reach out with those 3 different ways, and we will see you guys next time.
We have one. Do you want to answer one more question? One more straggler come in.
Of course.
All right. Let's see. Oh, Donna. Yeah. So it's at 3 o'clock Pacific time. It's 3 p.m. Pacific time tomorrow. So yeah, just calculate based on your time zone. But 3 p.m. Pacific time tomorrow should have an email going out pretty soon. You'll see that coming up. Yeah, for the webinar tomorrow, it'll be at 3 p.m. Pacific time.
And they're always recorded. So if you guys can't make it.
Yep, they're always recorded. So perfect. We did have one more question from David. So the question from David here, it says, if you over contribute to the 401k for 2021, are there any consequences? Can the over contribution be deferred to 2022?
So great question, David. So that might have to be a distribution. Honestly, you should contact your CPA. I do not think that you can defer it to 2022. So you'll want to talk to your CPA as soon as possible. Unfortunately, it may have to be a distribution. And then we do have also another question from Nate. Do you know of any ways to start a company, have it be owned by a 401k or an IRA, and work for that company, perhaps without pay? So interesting question. So it's important to know that you want to keep all of your investments within your IRA and solo 401k as passive. So if you're starting an active company in your solo 401k and you're going to work for the company, this just all sounds like lots of prohibited transactions. And guess what? We have a great webinar in our network all about prohibited transactions. So Nate, it sounds like that's something you cannot do. Remember, we're keeping our investments passive within our solo 401ks. So that's really important. Your active business is what sponsors your plan. And then within your plan, your investments, those are all passive. Anything to add, Eric?
Yeah, I mean, anytime you're bordering on prohibited transactions, I would always check in with legal counsel. So, there are creative ways to potentially, like, depending on ownership of that business. But again, I would highly recommend having a great tax attorney if you're thinking of trying to do something like that, of that nature. The more creative it is, the more that potentially you're bordering on doing something you're not supposed to. So generally, we try to say, like, keep it simple, keep your passive investments in your 401k and your active investments or your business stuff outside. But the more complicated you want to get, the more you definitely need to have those other sets of eyes giving it the blessing, right?
Okay.
All right.
More stragglers here. No, we're happy to take your questions. We love this, guys.
Yeah, no, this is great. There's been a lot of good questions today. I'm glad. So I'm excited. I'm glad we're doing these on contributions, especially since there's still quite a few sole proprietors. We still are having quite a few people set up plans for 2020. So if you guys are a sole proprietor and you filed that extension, you still have time to do a 2020 plan. So, we can still set that up for you, and you can make 2020 contributions still.
But you have to do it today.
You have to do it right away, because it takes us a few extra days to do that, because our programmer has to make an update. So get on that right away if you're still wanting to make 2020 contributions. All right. It looks like that's it. Thank you guys so much for attending. Any other questions, shoot them to us in the network is a great place to post your questions, or shoot us an email. Obviously, to give us a call if you're a client, or schedule a call with me or Alana if you want to know more about the solo 401k or our other retirement plan options as well. Hope you guys have a great rest of the day. We'll see you guys on the next webinar.